Welcome back. I'm Don Rich, and today I'm breaking down my top 7 stock tips for beginners in 2025. If you're new to investing, this video is your roadmap. No jargon, just actionable advice. We'll cover where to put your money, how to invest regularly, and how to avoid common mistakes. Whether you have $100 or $10,000, these tips will help you build a solid, reliable portfolio. By the end, you'll have the confidence to start investing the smart way. Grab a coffee, get comfortable, and let's dive in. And if you find this helpful, hit that like button. It really supports the channel. Tip number 1. Diversify your portfolio. It's a fundamental principle that can significantly reduce risk without sacrificing potential returns. Think of it as a cornerstone of smart investing. Don't put all your money in one stock. That's like putting all your eggs in one basket, and if that basket drops, you lose everything. Instead, spread it across different companies and sectors. This way, if one sector underperforms, the others can help cushion the blow. Think of it as not betting your life savings on a single lottery ticket. The odds are stacked against you, and the potential for significant loss is high. Diversification protects you from big losses if one sector tanks. It acts as a buffer, mitigating the impact of negative events on your overall portfolio. In 2025, with unpredictable markets, geopolitical tensions, and rapid global shifts, diversification is more important than ever. The world is changing fast, and your portfolio needs to be able to adapt. The easiest way to achieve diversification? Index funds or ETFs. These funds, like an S&P 500 fund, instantly give you exposure to hundreds of companies, providing instant diversification with a single investment. This cushions your portfolio against downturns in any single industry, smoothing out the ride and reducing overall volatility. Remember the dot-com crash? A lot of investors learned a painful lesson about the importance of diversification during that time. Diversified investors survived, those all in on tech didn't. They saw their portfolios decimated, while diversified portfolios weathered the storm. You can also diversify by asset class. Consider adding bonds or REITs as you grow. This can further reduce risk and enhance long-term returns. For beginners, start with a broad market ETF. It's a simple and effective way to get diversified exposure to the market. The goal isn't to hit a home run with a single stock, but to grow steadily without catastrophic risk. Slow and steady wins the race. Diversification is your safety net and margin of safety, protecting you from unforeseen events and market downturns. Check your portfolio. Are you too concentrated in one area? If so, it's time to rebalance and diversify. If you're just starting, make your first investment a broad index fund. It's a great way to build a diversified portfolio from the ground up. Spreading your investments is called the only free lunch in finance. Less risk, same potential returns. It's a win-win situation. Don't try to predict the next big winner. Let diversification work for you automatically, without the need for constant monitoring and adjustments. It's the bedrock of any solid investment strategy, providing a stable base for long-term growth. Action step: buy a broad market ETF or index fund as your core holding. Make it the foundation of your investment portfolio. Review your holdings. Are you diversified enough? If not, take steps to rebalance and ensure you're adequately protected. This is the foundation for long-term investing success, setting you up for a more secure and prosperous financial future. Tip 2. Build your foundation with blue-chip stocks. These are the Apples, Microsofts, and Coca-Colas of the world, big, stable, and proven. Blue chips offer reliability, steady growth, and often pay dividends. They're less volatile than risky startups and help you sleep at night. When markets get rough, investors flock to these giants for safety. You won't get rich overnight, but you'll build wealth steadily. Look at the Dow Jones or the top holdings in an S&P 500 fund for examples. For beginners, anchoring your portfolio with blue chips or a blue chip ETF is smart. These companies have survived recessions, high rates, and global crises. Their business models are robust and their brands are powerful. Think of them as the bedrock of your financial house. You can always add riskier stocks later, but start with stability. Remember, investing is a marathon, not a sprint. Blue chips help you stay invested during market swings. Action step: add blue chip stocks or a blue chip ETF to your core portfolio. Focus on quality and consistency, not hype. This is your get-rich-slowly plan, and it works. Build your foundation first, then grow from there. Tip number 3. Invest consistently. This means investing regularly, no matter what the market is doing. Don't let short-term market jitters throw you off course. This powerful strategy is called dollar-cost averaging. Invest a fixed amount at regular intervals, like every month or every paycheck. When prices are high, you buy fewer shares. When prices drop, you buy more. It's like getting a discount when the market is on sale. Over time, this smooths out your average purchase price and significantly reduces your overall investment risk. Forget trying to time the market. No one can do it reliably, not even the so-called experts. Set up automatic investments so you don't have to constantly think about it or second-guess your decisions. Make investing a habit, just like paying your bills each month. Even $25 or $50 a month, consistently invested, adds up significantly over time, thanks to the power of compounding. Market dips? Great. You're essentially buying stocks at a discount. This disciplined approach removes emotion from the equation and keeps you consistently on track toward your financial goals. For example, investing $100 a month into a broad market S&P 500 index fund. Some months you'll get to purchase more shares, and some months you'll inevitably get less. But the most important thing is that you always invest, regardless of market conditions. Automation is absolutely key. Set it and forget it, allowing your investments to grow steadily over the long term. The real secret to successful investing is time in the market, which consistently beats trying to time the market. Your wealth grows steadily with consistency, not by attempting to achieve perfect timing. Your action step: decide right now on an amount that you can realistically invest regularly, and then automate the entire process. Don't wait around for the elusive, perfect moment to begin. Just start investing today. This single, powerful habit will have a truly huge and positive impact on your overall financial future and long-term wealth accumulation. Stay disciplined with your contributions, and let the magic of compounding do the heavy lifting for you. Consistency is truly your greatest superpower as an investor. Make your investing automatic, and then simply watch your wealth grow steadily over time. Tip 4. Allocate a small portion of your portfolio to emerging sectors. The future is being shaped by trends like AI, green energy, and healthcare innovation. These sectors offer big growth potential, but also higher risk. Don't go all in. Consider 5–10% of your portfolio for these opportunities. Instead of picking one stock, use sector ETFs, like BOTE for AI or ICLN for clean energy. This way, you benefit from the trend without betting on a single company. Do your homework, read industry news, follow experts, and understand the trends. Remember, for every Amazon, there are dozens of failures. Diversify even within these sectors. Action step: identify 1 or 2 trends you believe in and add a sector ETF to your portfolio. Keep your core in stable assets, but give yourself a shot at future growth. Stay curious and keep learning about what's next. This is how you balance stability with opportunity. Tip 5. Don't let emotions drive your investing decisions. It's easy to get caught up in the moment, but that's when mistakes happen. Fear and greed are the biggest threats to your returns, often leading to poor choices. Not market crashes. Market fluctuations are normal, emotional reactions are not. Panic selling locks in losses, it turns a temporary dip into a permanent loss of capital. Chasing hype leads to buying high and selling low. Resist the urge to jump on the bandwagon. The solution: have a written plan and stick to it. This will act as your anchor during turbulent times. Decide in advance how much you'll invest, setting clear financial boundaries for yourself. What you'll buy, based on research and analysis, not gut feelings. And when you'll sell, if ever. Having predetermined exit strategies can prevent impulsive decisions. Automate your investments to remove emotion from the process. Set it and forget it, as they say. Don't check your portfolio every day. It only fuels anxiety. Step away from the screen and focus on other things. Remember, a market dip is a sale, not a disaster. It's a chance to buy quality assets at a discount. For long-term investors, downturns are opportunities to buy more at lower prices. Embrace dollar-cost averaging. Warren Buffett says the market rewards the patient, not the impatient. Impatience often leads to rash decisions and missed opportunities. Focus on your long-term goals, not short-term noise. Tune out the daily market chatter and stay the course. Action step: write down your investment plan and automate your contributions. Make it a habit, not a reaction. When markets get volatile, review your plan instead of reacting emotionally. Remind yourself why you started investing in the first place. Stay disciplined. Successful investing is about what you don't do. Sometimes the best action is no action at all. Don't panic, don't chase trends, and don't tinker constantly. Overmanaging your portfolio can be detrimental. Let your plan work for you over time. Compound interest is a powerful force. Give it time to work its magic. patience and discipline are your greatest investing assets. Cultivate them, and they will serve you well. Be the calm investor. Your future self will thank you. Investing is a marathon, not a sprint. Tip 6. Use tax-advantaged accounts like 401(k)s and Roth IRAs. These accounts let your investments grow with huge tax benefits. A 401(k) gives you a tax break now. A Roth IRA gives you tax-free withdrawals later. If your employer offers a 401(k) match, contribute enough to get the full match. It's free money. After that, open and max out a Roth IRA if you can. In a Roth, your money grows tax-free and you keep every penny in retirement. Don't let jargon scare you. These accounts are simple and powerful. Prioritize them before investing in a regular brokerage account. Action step. Check if you're using your 401(k) and Roth IRA to their full potential. Open a Roth IRA at a major brokerage if you haven't already. Max out contributions if possible. These accounts can mean hundreds of thousands more in your pocket over time. Taxes are guaranteed. Minimize them to maximize your wealth. Make tax-advantaged investing your default. It's one of the smartest moves you can make for your future. Tip 7. Commit to lifelong learning. The financial world changes fast. Staying informed is your edge. You don't need to be an expert, but dedicate a little time each week to learning. Read a classic investing book, follow a trusted YouTube channel, or listen to a finance podcast. Focus on credible sources, not hype or clickbait. The more you know, the more confident you'll be in your decisions. Understand the why behind the advice. This builds conviction during tough times. Make learning a habit, not a chore. Action step, pick one book or podcast to start with this month. Keep building your knowledge base over time. Your education is the best investment you'll ever make. Stay curious, stay disciplined, and you'll be ready for whatever the market brings. This is the final piece to building lasting wealth. That's it. My top 7 stock tips for beginners in 2025. Start with diversification, build on blue chips, invest consistently, and use tax-advantaged accounts. Explore future trends, control your emotions, and keep learning. Don't wait for the perfect moment. Just get started. The sooner you begin, the more powerful compounding becomes. Drop your questions or favorite tips in the comments, and don't forget to like and subscribe. Thanks for watching. See you in the next video.